Now talk us through market activity. The bourse is continuing to extend gains firmly above that 3,300 level mark.
Yes, there is a bit of hype behind the reporting season, which is normally expected, and the profits are actually coming in slightly above average and above what most analysts have forecasted. So it has created some excitement in the market, and people are hunting for those dividends and any type of income they can get from the market.
Talking on the results that are coming out, we are expecting results out from two banks tomorrow. Let's take a look at Equity Bank. What are your expectations on that front?
I'm not expecting so much from them. Yes, they will have double-digit growths, most probably at maximum 35% growth in profit before tax and maybe 30% growth in net interest income. What I'm a bit worried about is the level of growth of their non-funded income side, which I think naturally will come in around 18 and 20% year on year. However, we would like to see that sector of Equity Bank growing faster, as they are more of a volumes type of bank, which has the masses in them. So the transaction income should be naturally end up being higher than or close to their interest income. So that's the line that I will really be looking at tomorrow. And my fear is that it will not grow that much to spare further excitement on the counter in the market.
Looking at dividends, we've had a lot of banks also coming out with a dividend. Could we perhaps expect a dividend coming out of Equity Bank tomorrow?
Yes, the dividend will be there, but I don't expect it to be that high. And historically, they normally don't pay so much in dividends. They'll rather give a bonus or a split and keep the funds in the company. So maximum 1 shilling 50 cents to 2 shillings.
Looking at Cooperative Bank, also expected out with results. That bank led gains in yesterday's trading session, up 8% to 12 shillings and 95 cents. Ahead of those full year results, do you see them surprising on the upside like the other banks that we have seen release results?
No, not really surprising. For them, I actually expect results which are slightly higher than Equity Bank, maybe around 45% growth on profit before tax. Dividend-wise, I don't think they will actually pay dividends because they already issued a warning in December that the other dividends will remain the same. So they will actually not increase the dividends because of the good results. So even as people are trading on the counter, especially the people that are coming in for income on the counter, need to be aware of that. But in terms of results, I think the results will be good and might actually be better than most of the banks that have reported so far.
Looking at the banking sector, what are your preferred picks within the sector?
After this reporting season, unfortunately none, because basically the cost of funding is still high, and private credit has been slowing down from December to January. So if people are not taking up loans, which is their main top line, like what I was saying again about the non-funded income, most banks have not invested much in their non-funded income, and they've tried to drive their margins from the interest income, which the margins have become so low because of the cost of funding. So I don't think they'll have exponentially high growth returns this year compared to last year. And that in itself, with the misinterpretation in the market, might have an impact, a negative impact on their stock prices as we go along the year. So it's an issue of monitoring when the books close. Will the stocks actually be able to come back after going ex-dividend? Will they be able to recover and take you into positive? So personally, I actually don't have a preferred peak in the banking sector.
Looking at a factor that has had an effect on banks is the high interest rate environment. We had the central bank leaving interest rates unchanged at 18%, citing the risky inflation outlook, with some analysts really saying that this is an indication that the high interest rate regime might be there for a while. Are you also seeing this trend continuing?
For the greater part of this year, I don't think the central bank will do much to its rate. They're really besieged by this small demon called the shilling. Once that rate moves slightly lower, they will lose the battle against the shilling. But clearly the shilling is being maintained by, one, the high interest rate, and which is slowing down the demand pressures on inflation and them mopping up liquidity in the market. So naturally, you'll find interest rates will remain around that area of 19-20%, even as much as we've seen the 91-day Treasury bill slightly come down. Truth be said, we are not yet out of the woods yet. In terms of inflation, global oil prices are up 13% year to date. Copper prices are up 9%, sugar prices are up 8%, which are all the major part of the import bill for the country. So inflation is going to start coming back up in the coming months and in the coming few weeks. So them maintaining the rate at 18% is, I hope, foresight of that, and not just fear of losing the shilling. But anyway, either way, the way they've done it or the motive they've done it for will at least serve to reduce the impact of inflation pressures that are going to come in the next couple of weeks.
The inflation environment likely to have an impact on the economy going forward. So with this type of scenario, with high inflation rate, the shilling at current levels, what type of scenario are you seeing playing out for GDP numbers going forward?
GDP, basically, my forecast for 2011 was already at 4%, which is a huge reduction from the 5% that most people are actually coming up with. And for 2012, I see it around still the 4% down to 3.8% GDP growth for the year. Because you have high interest rates, so that means you have reduced credit and you've reduced investment. So that affects that part of GDP. You have the agricultural sector suffering from reduction in tea prices, which are down 12.3%. Coffee prices are down 12.9%. So again, your agricultural sector is not going to perform that well because of reduced yields. So if you take the factor that the agricultural sector is linked to the other sectors of the economy, manufacturing sector will be affected, but the major component of the manufacturing sector is food processing. So if there's no food being produced, the food processing goes down. Cane delivery goes down. Construction sector also is going to be affected because of the higher interest rates, because of mortgage. So naturally, it's going to be a really slow year in terms of GDP, and this will trickle down even when you see after, like I said, after the books close in the market, there's really nothing exciting that will get investors to come back into the market.